Hi everyone, today's lesson we are solving a question which requires you to understand the provision for depreciation of machinery account and how relevant disposals can affect this account. So we have got two questions as you can see on the left hand side of our screen, and on the right hand side we have got all the workings which I'll explain step by step. With that being said, let's begin. On the 1st of April 2021, a business purchased a machine for $120,000 with an estimated residual value of $12,000. On 1 July 2022, this machine was sold for $100,000. So we can understand that the machine was bought on the 1st of April 2021 and was sold on 1 July 2022, which means the machine was used in the business for a total of 15 months. We have got 9 months in 2021, which are the months April, May, June, July, August, September, October, November, and December, and then 6 months in 2022, which are the first 6 months, which are Jan, Feb, March, April, May, and June. Machinery is depreciated at the rate of 20% per annum using the straight line method. Depreciation is calculated for each month of ownership. Which entry should be made in the provision for depreciation of machinery account for the disposal of the machine? And there is a second question. Also calculate any relevant profit or loss on disposal. Now we can clearly understand that the machine was used for 15 months in the business, starting 1 April 2021 and ending 30 June 2022. Now we can calculate the depreciation using the straight line method. So we start with the given percentage of 20, which is an annualized rate, which means it is valid for 12 months. And then we multiply it with the difference between the purchase price and the residual value. The residual value refers to the selling price that we could likely get once the machine has been utilized in the business. Okay? Now, then we multiply it with 15 over 12. Now we understand that 20% is an annualized rate, which means it is valid for 12 months. But we are converting this 12-month value into a 15-month value by multiplying it with 15 over 12, which then apportions this 20% into a 15-month rate. So that gives us a depreciation of $27,000 for the 15 months. Now we are interested in the carrying amount or the net book value during disposal, which is the difference between the cost and the accumulated depreciation. The cost, as we know, is $120,000 given in the first sentence of the question, and the depreciation we have for the 15 months is $27,000, which when we deduct from $120,000, we get $93,000 as the carrying amount or net book value during disposal. Now, in the second sentence of the question, it mentions that the machine was sold for $100,000. We had $93,000 of economic benefits still available for consumption or utilization within the business to help the business generate more revenue. But the business sold it for $100,000, which means a profit of $7,000 has obviously been made. Now, how does this affect the provision for depreciation account? The provision for depreciation account is a contra asset account, right? What do we understand by a contra asset account? Contra asset accounts are prepared separately to the main asset account so that all the relevant reduction for that specific asset can be stored and recorded within this ledger account. As the name clearly says, contra asset, contrary to the original asset account. Now all asset accounts by default have an opening balance on the debit side. But because we are dealing with a contrasted account, logically speaking, it should always have an opening balance on the credit side. Obviously, it is in contrary to the original asset account. So on the credit side of the provision for depreciation or accumulated depreciation ledger account, we are including the opening balance, which is balance brought down. Therefore, the closing balance must be recorded on the debit side, which is balance carried down. Now, anything that is entered on the credit side of this account will mean that the provision for depreciation or the accumulated depreciation is increasing. But anything that is entered on the debit side of this account should obviously reflect a reduction in provision for depreciation or accumulated depreciation balance, right? So does that not mean that the disposal of asset should be definitely recorded on the debit side, and the total provision for depreciation for the asset which we disposed was $27,000? That must be recorded here on the debit side to reflect a reduction in the books, that the provision for depreciation can now be reduced by $27,000 because an asset has been sold to an external party outside of the business. Okay? So as we can clearly understand, within this provision for depreciation ledger account, we are recording the relevant disposal of asset depreciation on the debit side. Therefore, the correct option to select for the first question that we have just solved is option D, which is $27,000 debit. And also we have already calculated the profit on disposal of $7,000. Now let's start with the second question, which involves some algebra. Sue purchased a new machine. She depreciated it at a rate of 40% per annum using the reducing balance method. After 2 years, its net book value was $3,600. What was the purchase price of the machine? So we can start this question by assuming the purchase price of the machine is X. And now we can find the depreciation in year 1, which is simply multiplying the given rate of 40% with the purchase price of X, that is 0.40X. Now, because we are using the reducing balance method, we always calculate the net book value or the carrying amount at the end of the financial year, which in this case is to derive the net book value at the end of year 1. And the net book value or the carrying amount at any given point in time is simply the difference between the cost and the accumulated depreciation. The cost, which is the purchase price of X that we assumed, and then we are deducting 0.40X in the depreciation expense for the first year. That gives us a net book value of 0.60X. Now moving on to the second year, using the reducing balance method, the depreciation is now calculated by multiplying the given rate of 40% with the net book value of 0.60X that we had derived at end of year 1, which gives us 0.24X. Therefore, the net book value at end of year 2 is derived as the difference between the net book value at end of year 1 and the depreciation we calculated for year 2. So which is 0.60X minus 0.24X, that is 0.36X. Now based on the second last sentence of the question, it specifies that after 2 years its net book value was $3,600. So that means we can now create an equation where we can write 0.36X being the net book value at end of year 2 equal to $3,600. So we just now simply solve for X, which is the purchase price of the machine, by dividing 3,600 with 0.36, and that is $10,000, which therefore is option C.